Subscribe to UK Pensioner Hub for the latest updates on pensions, benefits, and financial guidance tailored specifically for UK seniors. Are you a UK pensioner worried about your tax obligations this year? You're not alone. Thousands of retirees across Britain are feeling anxious after HMRC issued fresh warnings about tax compliance for 2025. If you're receiving a pension, whether from the state or a private scheme, this information could directly affect your finances and peace of mind. The truth is, many pensioners don't realize they might owe tax on their retirement income. With new thresholds, changing allowances, and stricter enforcement measures coming into effect, HMRC is making it clear that seniors need to pay closer attention to their tax affairs than ever before. Missing these warnings could result in unexpected tax bills, penalties, or even investigations. Today, we're breaking down everything you need to know about HMRC's 2025 tax warning for pensioners. We'll explain what's changed, who's affected, and most importantly, what actions you need to take right now to protect yourself from unnecessary complications and financial stress. Let me start by addressing the most pressing question on everyone's mind. Why is HMRC specifically targeting pensioners with these warnings? The answer lies in a perfect storm of factors. First, the state pension has increased significantly in recent years thanks to the triple lock guarantee. While this is wonderful news for pensioners' incomes, it also means more seniors are being pushed over the tax-free personal allowance threshold. Second, HMRC has been improving its data matching capabilities, making it easier to identify pensioners who may have undeclared income or unpaid tax. Third, there's been a notable increase in pensioners working part-time or drawing from multiple pension pots, creating more complex tax situations. Let's talk about the personal allowance because this is absolutely fundamental to understanding your tax position. For the 2025 tax year, the personal allowance remains frozen at £12,570. This means you can earn up to this amount before paying any income tax. However, here's where it gets tricky for pensioners. The full new state pension for 2025 is £11,502 per year. That leaves you with only about £1,000 of your personal allowance remaining before you start paying tax. Now, if you have any additional income, whether that's from a workplace pension, a private pension, savings interest, rental income, or part-time work, you could easily exceed your personal allowance. Many pensioners are shocked to discover they owe tax because they simply didn't realize that all their income sources needed to be added together when calculating their tax liability. HMRC's warning specifically highlights several groups of pensioners who are most at risk of underpaying tax. If you fall into any of these categories, you need to be particularly vigilant. The first group includes pensioners receiving income from multiple pension sources. Perhaps you have a state pension, a final salary pension from a previous employer, and you're also drawing down from a personal pension pot. Each pension provider will apply tax codes, but they might not have the full picture of your total income. This can lead to underpayment of tax throughout the year. The second at-risk group consists of pensioners who've returned to work, even on a part-time or casual basis. More seniors than ever are choosing to continue working past state pension age, whether for financial reasons or simply to stay active and engaged. If you're working and receiving a pension, you must ensure your tax code reflects both income sources. Many employers and pension providers operate on a month-one basis, which can result in incorrect tax deductions if your circumstances change mid-year. The third category includes pensioners with savings and investment income. With interest rates having risen significantly over the past couple of years, many pensioners are now earning substantial interest on their savings accounts. While there is a personal savings allowance of £1,000 for basic rate taxpayers and £500 for higher rate taxpayers, any interest earned above these thresholds is taxable if your bank or building society isn't deducting tax at source. You're responsible for declaring this income to HM Revenue and Customs. Property income is another area where HMRC is focusing attention. If you're a pensioner who rents out a property, whether it's a buy-to-let investment or you're renting out a room in your home, this income must be declared. The Rent-A-Room scheme allows you to earn up to £7,500 tax-free if you're renting out furnished accommodation in your main home, but any amount above this is taxable. Full rental income from separate properties must be declared regardless of the amount. One of the most concerning aspects of HMRC's 2025 warning relates to pension withdrawals. If you're accessing a defined contribution pension through flexible drawdown, each withdrawal is treated as income for that tax year. Many pensioners make the mistake of taking large lump sums without realizing the tax implications. While 25% of your pension pot can usually be taken tax-free, The remaining 75% is subject to income tax at your marginal rate. Taking too much in one go could push you into a higher tax bracket, resulting in a substantial tax bill. HMRC has also warned about the emergency tax situation that often occurs with pension withdrawals. When you first access your pension, your provider might not have the correct tax code and will apply emergency tax, which can mean you pay far too much initially. While you can claim this back, it causes cash flow problems and stress for many pensioners. The key is to ensure your pension provider has your correct tax code before making any withdrawals. The state pension age is another factor causing confusion. For those reaching state pension age in 2025, it's currently 66 for both men and women. However, you don't automatically stop paying national insurance or income tax when you reach state pension age. If you continue working, you'll stop paying national insurance contributions, but you'll still pay income tax on earnings above your personal allowance. This is a common misconception that leads to pensioners being underprepared for their tax obligations. Let's discuss what happens if you owe tax to HMRC. If you're employed or receiving a pension through the PAYE system, HMRC will typically adjust your tax code to collect underpaid tax over the following year. However, if you owe a significant amount or have untaxed income, you may need to complete a self-assessment tax return. Missing the deadline for self-assessment, which is January 31st following the end of the tax year, results in automatic penalties starting at £100 with additional penalties accruing if the return remains outstanding. HMRC is being particularly firm about penalties in 2025. They've made it clear that ignorance is not an excuse. If you should reasonably have known you owed tax, you can be charged penalties on top of the tax owed. These penalties can range from 0 to 100% of the tax due, depending on whether HM Revenue and Customs views the error as careless or deliberate. For most pensioners making honest mistakes, penalties are typically in the lower range, but there's still an unwelcome additional cost. So, what should you do right now to ensure you're compliant with HMRC's requirements? First and foremost, calculate your total income from all sources. This includes state pension, private pensions, employment income, savings interest, dividends, rental income, and any other taxable income. Add all these together and compare the total to your personal allowance of £12,570. If your total income exceeds this amount, you will owe tax. Next, check your tax code. You can find this on your pay slips, pension statements, or by logging into your personal tax account on the gov.uk website. Your tax code should reflect your personal allowance and any adjustments HMRC has made for other income sources. The standard tax code for 2025 is 1257L, which gives you the full personal allowance. If your code is different, make sure you understand why. If you believe your tax code is wrong, contact HMRC immediately to get it corrected. Consider whether you need to register for self-assessment. You must complete a self-assessment tax return if you're self-employed, a company director, have rental income over £2,500, or have untaxed income over certain thresholds. Even if you're not legally required to file a return, it can be a good idea if you have multiple income sources, as it gives you and HMRC a clear picture of your total tax liability. Review your pension arrangements carefully. If you have multiple pensions, ensure each provider knows about your other income sources so they can apply the correct tax treatment. When planning pension withdrawals, consider spreading them across multiple tax years rather than taking large lump sums, as this can help you manage your tax liability more efficiently and avoid being pushed into higher tax brackets unnecessarily. Keep thorough records of all your income and any tax paid. This includes P60S from employers and pension providers, bank statements showing interest earned, records of rental income and expenses, and any correspondence from HMRC. Good record keeping makes it much easier to complete tax returns accurately and can protect you if HM Revenue and Customs has questions about your tax affairs. If you're struggling to understand your tax position, don't hesitate to seek help. HMRC has a dedicated helpline for older people on 0300 200 3300, where advisors can help you understand your tax obligations. Additionally, many charities offer free tax advice for pensioners, including Age UK and Tax Help for older people. Professional tax advisors can also assist, though there will be a fee for their services. One final point that HMRC is emphasizing in their 2025 warning is the importance of informing them about changes in your circumstances. If you start receiving a new pension, begin working, sell a property, or have any other significant change that affects your income, you should notify HMRC promptly. This allows them to adjust your tax code appropriately and helps prevent underpayment situations from developing. The bottom line is this: HMRC is getting increasingly sophisticated at identifying pensioners who owe tax, and they're taking a firmer approach to enforcement in 2025. However, if you take proactive steps to understand your tax position, keep good records, and communicate with HMRC when necessary, you can stay compliant without stress or penalties. The vast majority of pensioners want to pay the right amount of tax. It's simply a matter of understanding what that amount is and ensuring it gets paid. Remember, paying tax isn't necessarily a bad thing. If you're paying tax, it means you have income above the basic personal allowance, which puts you in a more comfortable financial position than many. The key is making sure you're paying the right amount, not too much and not too little, and that you're organized and informed about your obligations. Don't let HMRC's warnings frighten you into inaction. Instead, use them as motivation to review your tax affairs, get organized, and ensure you're fully compliant. Taking action now will give you peace of mind and help you avoid problems down the line. If you found this information helpful, please subscribe to UK Pensioner Hub and hit the notification bell so you never miss important updates that could affect your finances. We're here to help you navigate the complexities of retirement in the UK with clear, practical advice you can trust. Subscribe now and join our community of informed pensioners taking control of their financial futures.